Let's answer some questions from the last Q&A. First one, if the thesis is irrational Fed, irrational government, can't trust the U.S., why is the trade to go long U.S. debt instead of gold? Who said it was one or the other? I think you go long U.S. debt. Well, let me rephrase that. I am long U.S. debt as a artifact of the decisions I had made in the past. So I'm going to sit tight because it gives me the requisite duration exposure. I may switch from TLT to long-term bonds. But I don't think I ever made a distinction and a choice saying, hey, look, you're either long U.S. debt or you're long gold. Why can't it be both? You're still relying on subsequent irrational Fed actions to curtail the long end? I am. If the Fed and U.S. government are irrational, gold is going up regardless of what they do next. I believe that's true. After Liberation Day, if you bought TLT for safety on Monday following, you'd be flat today, whereas gold is up 40%. Again, we don't have to live in an either-or world. Why can't it be both? We know what it has done, so to say, oh, you should have been in gold, look what it did, TLT did nothing, you don't know what's going to happen going forward. The world could like the relationship between the Fed and the Treasury. The world could like what happens in the U.S., and based on what the Fed and the Treasury do together, pushing rates down could cause a huge investment boom in the U.S., king dollar, generate GDP growth, which has a higher tax haul. There could be adults in the room who then say, let's start paying down some of this debt. Let's start dealing with that. And I mean, you don't know what's going to happen. You don't know. So why not both? If you believe that REITs and financials will be the place to be when rates drop, would you consider going into Fannie Mae? Well, that's sort of a continuation from the first one, saying, well, I don't think I made a distinction between the two. You can get your duration exposure wherever you like. I don't know that Fannie Mae is duration, however, as much as it is issuance. And I'm not really sure that it's. I don't know that I would call it duration as much as a mortgage REIT would be. But if you see duration in there, you can get it from anywhere if you're looking for factor exposures. I do get this quite often, and the answer to this is quite simple. Every individual has a limited bandwidth of things they can look at, of stocks they can consider. You know, I'll highlight a stock in the market outlook, and somebody says, well, how come you didn't say anything about XQP? Never heard of XQP. There are like 6,000 or 7,000 stocks out there. I can't possibly know them all, rank them, and then take all the ones that people would then bring up after. Well, if you like XLP, you should have liked T22. Well, what the hell is that, right? I mean, there's so many of them out there. Yeah, you can get your duration wherever you like. On your positions video and on your MO stock analysis, you mentioned you would date a benchmark to a call. Could you explain how you would do it? Well, I like volatility. Volatility just means you have this going on, right? That's what it means. This is not volatile. That is not volatile. It's directional. This is not volatile. That's directional. Even this, right? You may have volatility in around it, but that's not volatile. I like volatile stocks that move. So you can play it if you think about a chart and you think about taking wherever the stock price is, you find some option, and every option has a delta. What you want to do is sell on the way up, and you want to buy on the way down. Well, you can do that psychologically, but you'll run into trouble doing that psychologically. So you want some kind of objective objective point to use, and that's what a delta will give you. So you use a put if you're playing the long side, and it will tell you to sell on the way up, buy on the way down. If you're playing the short side, it will tell you to sell on the way up and buy on the way down. The difference is when you buy on the way down on the long side, you are adding delta. And here, when you sell on the way up on the long side, you are adding to your negative delta. So long, you're adding delta, and then you're reducing delta, increasing delta, reducing delta. If it's the short side, you are increasing negative delta, reducing negative delta, increasing. And it doesn't really matter what side you play it on. If the volatility is big enough, you really don't want overnight risk if you can at all avoid it, because these kind of high volatility stocks, they can surprise you after hours. You want to at least be delta neutral, or try to get delta neutral overnight. When you have big IV, you have lots of doorways open in all of the options that you can hedge out completely, almost completely, your delta overnight. That's all. If you don't know how to do this, hard for me just to describe in a Q&A session. If you don't know how to do this, don't try it. If you've never sort of done this kind of benchmarking, because with this benchmarking, you're basically trading at the rate of gamma. You're basically gamma trading. It's not pure gamma trading, but it is a form of gamma trading, which trades the volatility. You're not too concerned about the direction, but you will have to take some directional bias, knowing that you can hedge it out. Credo had a chart that looked like this, and then had earnings, and up it went, and its revenue base is still quite low over the course of the year. So I made the decision at these higher levels that I would play its volatility from the short side. That does not mean I advocated on shorting CRDO. It just means I was going to gamma trade it from the short side, meaning I'm going to benchmark to a call. I know it sounds abstract, but if you know how to do it, it's pretty straightforward. Any plan for a synthetic long in gold? As of right now, I've sort of just let that go. I've made my money in gold. I did fairly well on the way up. I do believe there is more to go with gold, but I will wait. I was going to wait until Trump announced the new Fed chair, and the new Fed chair gave his acceptance speech, because that's usually what they do. But now they've canceled all the interviews, because I guess the Mad King has made his decision, and he will let us know now early in the year, in the new year. So we're not going to have it this year, but the belief is that it's Hassett. I'm going to say that I'm not really completely sold on that. I think what he is doing is he's just seeing how the market would react to that name. And if the market doesn't react in a way that's favorable, by beginning to price in cuts while maintaining discipline on the long end of the curve, then he has the ability to change his mind. But this is a sort of an old technique, is why not let the market choose? Wouldn't surprise me if in a couple of weeks it was a different front runner, and let's see how the market reacts to that, right? Could be. Or it could be that he's made up his mind based on who he thinks is going to bow down the deepest when he says, cut rates. Yes, sir, yes, sir, yes, sir. If he could appoint Marco Rubio, I think he would. I have not seen anybody kiss ass to the extent that Rubio kisses ass. Have you ever heard him speak? My God, my President Donald Trump, no other president than President Donald Trump. He can't say the words President Donald Trump enough times. That's a new drinking game, by the way. Is that every time Rubio gives an interview, you have to take a drink every time he says President Donald Trump. Every single time. But a warning here, this does come with serious health risk and a serious risk of alcohol poisoning. So only for the true drinkers would you play that game. Thoughts on the mid to long-term risk of Chinese state-subsidized LLMs offering 95% of their performance of US LLMs at a fraction of the cost. Well, if they can do it, so can the American ones, right? I mean, if they can do it, so can the U.S. The U.S. firms. This is not unique to the Chinese firms. It's not as if everyone's scratching their head saying, "Well, how the hell they do it?" They know how they're doing it. They're just choosing not to. And they're doing it in part because they're using APIs for the bigger foundational models. I don't know. As from a consumer perspective, do you find that bad? From a consumer's perspective, you might find that good. Or you might say, you know what? I don't trust putting my prompts into these Chinese models. I don't trust asking it questions about anything. I don't trust it with any of my personal information. You may get to that point where that trust factor becomes a huge, big issue. Or may not. But I don't know that I would be too concerned that is going to be the future. I use some of these models. They're pretty good one-dimensionally. Like DeepThink, if I have these other models, I don't really need DeepThink. It's somewhat less than what I have. So I'm not too eager about them. This would ostensibly eat into the margins and pressure the financial base of U.S. hyperscalers or providers. China jumping rare earths onto the market in the 90s, suppressing consolidation. U.S. producers. There's also evidence of many U.S. firms choosing to integrate with less expensive Chinese LLM providers over U.S. providers. I don't know what you mean by many U.S. firms choosing to integrate. Well, I'm not sure what that means, integrate with them. And when you say U.S. firms, what U.S. firms? So I don't know how to take that last sentence. It's too vague. Is it something you read somewhere? Do you know this? Do you know these U.S. firms that are, quote, integrating with less expensive Chinese providers? And I'm not sure what that means. They're integrating with them. So I don't know what that means. I would be skeptical of that sentence saying, I don't think it means the words that you have written down there. I think it means something else. But maybe you mean it's more than likely that some U.S. Firms and individuals will choose to use these models, because I don't know what integrate means. All Japanese yields are at multi-year high. When will this be a concern for you? Oh, I don't have Japanese debt, so you tell me. Rather than me guessing as to what you mean by this, you tell me. Why I would be concerned with something I do not own in a country that has its own particular debt problem that's probably the biggest one in the world. If you mean that because this is happening to the debt in one country, that it's going to happen to something that I'm holding on to, I would need you to draw that line for me, as opposed to me guess what that line looks like and hope that I guess the same line that you're thinking. So it's, I do have these comments every now and then. Aren't you concerned with this going on over here? Why? Why would I be concerned with something way over there? Unless you draw the line for me and say, this has the potential to do this, does that concern you? Then at least I know the mechanism by which I should be concerned. I mean, I could do the same thing. Aren't you concerned with the forecast for the colder winter we have? And your answer might be, why? right? Why? Unless I draw the line to your house and say, here's why you should be concerned. It's hard for me to answer these questions, but not really, I guess would be my answer. Some Bitcoin treasury companies are trading under one, and one of them owns 600 million of Bitcoin. Well, that's nothing. 600 million of Bitcoin, that's nothing. Has 200 million of debt and has a market cap of 200 million. I'm considering a spread short Bitcoin, long that company. How would you go about setting this up? Considering the 200 million in debt. Well, I don't think you care about the 200 million in debt. These are assets. Yeah, the debt has preferential access to the assets, but that really doesn't matter. You would look at the assumption that the debt is the debt and the debt will be taken care of and those assets belong to equity, and you would set up a trade that is Bitcoin neutral, as much Bitcoin neutral as you possibly can. And your theory is, if the bondholders have to take the Bitcoin and sell it, the price of Bitcoin would go down, but the shares would go down. I would say do that with strategy, because 600 million, that's nothing. That's nothing. That's not going to budge the price of Bitcoin at all. So, I don't know, other than a day's red, it's not sustained selling and it's not a threat to the thesis of Bitcoin. MicroStrategy is a big deal. But this is nothing. I would ignore this. I wouldn't do anything here. If you want to do something, do it with strategy. There are no options on the stock, but out of curiosity, I'd like to know how you would do it without options. I would not do it. Make sure you check the borrow rate on that stock. It's probably ugly. But this is nothing. I wouldn't do it. I've looked at operating loss. They're all losing money. They all lose money, as well as ownership. 70% retail owned. That's the standard footprint. Anything else you take into consideration before entering a trade like this? Well, like I said, I wouldn't do it. How likely is a company that is to be acquired and liquidated to unlock its NAV? Unlikely. Seems like a lot of us white-collar workers might be falling into the trap of primarily considering how AI will augment our jobs that consist of a lot of thinking and keyboard clicking. There are plenty of great investing opportunities and business ideas in this software world. That sentence doesn't seem to follow from the first sentence. On the flip side, what are your thoughts on the physical... Okay, third sentence doesn't seem to follow from the second sentence, unless they're all just disjointed thoughts. Some of us white-collar workers might be falling in the trap of primarily considering how AI will augment our jobs that consist of a lot of thinking and keyboard clicking. Period. Next thought. There are plenty of great investing opportunities and business ideas in the software world. Period. Next thought. On the flip side, yeah, they don't follow. What are your thoughts on the physical industrial implementation of AI? Not necessarily humanoid robots, but for example, factory and supply chain automation like never before possible. Oh, Trump, no one's ever seen anything like this. Like never before possible, you're picking up some bad habits. What examples are you seeing of real world use cases coming to fruition? Well, look at CAT. You have vehicles for mining applications that completely drive themselves. And why do you even need humans down in the mine? There you can build special purpose robots, and again, they don't have to be humanoid, special purpose robots to do everything a human can do down there. I do envision 5-10 years in the future, there'll be no underground miners. There'll be no coal miners. That will all be highly automated. John Deere factory, all the equipment for the farm can completely do everything on the farm without farmhands. It can plant the seeds and more efficiently as well. It can fertilize that exact area. It can continue to fertilize through the season, and it can even harvest, all without a driver. I want you to think about that. You don't need all those farmhands anymore. Productivity, straight up. So Cat and John Deere are two good examples of where this is being done. Sorry about the beeping there. We'll move that away as everyone looked at their phone as soon as they heard that. Is that me? Is that me? Somebody want me? Is that for me? Are your reasons why you covered Credo and A-Lab before more fundamental data center internet companies like Amphenol, I never heard of it, and Corning? Any reason why you? Because I never heard of them. And again, like I said earlier, you can't possibly know it all, right? And whatever company I would pick to highlight next this Sunday, I'm sure in the comment section I get, how come you didn't mention this company? I'm surprised you didn't mention that company. It's like, well, look, like I can't do it all. It's not that I purposely made any decision to push all the others down below number one, saying this is the one to know. It's like this is something to know. There are other things to know. I just can't possibly do it all. I know. It comes as a shock to some of you. What? But I can't. What are your thoughts on ABR currently with the recent sentiment and stock price dropping after most recent earnings? Possible probable rate cuts in 26 would help sentiment. Well, I'm concerned with the amount of loan modifications, and that not only are they modifying some loans and leaving people in place, which they should if you're going to modify the loan, they're actually taking over some of the properties and becoming landlords. And it's not a 2 or 3 loans here, it's quite a few. I'm concerned about that. I'm concerned that many of the properties are in states that relied on a whole bunch of immigration to fill those apartments and to pay those rents, and that they're gone. Right? ICE is all over the place. They're doing a big operation in Louisiana now. Get them brown people out, they say. I am concerned about all of that. This is kind of a big deal. Okay, you can say, look, we can save the property, we'll take it over, but you still got to get the tenant, and you still have to be able to raise the rent, and you still have to be able to turn it over to another buyer later on. These are mounting problems. I think if you didn't have the ICE sweep going through, I think you would have been okay. The strategy is sound. You take Class C and low Class B properties, you upgrade them, you upgrade the tenant, you focus on that blue collar type building in those particular neighborhoods. You stabilize those rents, and then you move them over to the GSE. And then you have the mortgage servicing rights behind that as well. The pipeline made a lot of sense. The link in there that ended up being the weakest link was humans. There was never a question before about, well, can you rent them out? Yeah, you can rent them out in the places where they were, lots of exposure to rent it out, and then boom, that's gone. So that is a wild card that, what are you going to do there? I'm not ready to touch ABR just yet. Is there any chance we can get the Tuesday, Thursday, Sunday GlobeX live videos recorded and archived soon after, perhaps in the market session feed? It's tough for those of us in different time zones to catch them live, and would love to catch up on the content we're missing, even the ad hoc live market facing ones as well. Starting in January, we're going to 6 a week, right? We do the Sunday night pre-week setup, and then we're going to do the early morning setup each morning. Recording these, getting them up on YouTube, getting the link in there. This is all going to be unmanageable. It's even unmanageable now. Just the management of all that. I don't know that I'm going to continue recording them. I'm not right now. I didn't do anything this week. I don't think I'm going to record the one Thursday morning either. It just doesn't make a lot of sense. It's difficult to get done. And they are really meant to be in the moment. If you're in the market, this is not an awkward time for you. If you are a serious player and you are in the market, you're up. It doesn't matter what time it is, you're up, because these are at 8:15. Market open wherever you are. The market opens in an hour and 15 minutes from when I start. So you would be at your desk. If you're not, then you're not really in the market, which means I don't know that you'd get a lot of benefit from these hours after the fact, because they do have a decay. It's not as if you're going to watch them at the end of the day. They do have a decay, being that they are for the day. So I think it's going to be extremely difficult and time-consuming to try to record these things. I started by recording them, and because once you're done recording them, you don't spend the next half hour taking care of it, because the market opens shortly. You got to get back to the work you were doing. This is not a part-time job for me here. This is the serious things. Do you think this will be the first time the 3-month 10-year yield curve inversion wasn't followed by a recession? No, there will be a recession. I don't know when, but there will. And when you look at the chart, you'll see that it uninverted, and shortly after there was a recession. Unless we never, ever, ever have recessions again, this will be followed by a recession. Right? I paper traded Credo's earnings with a short put at 160, and it would have worked beautifully. That said, I want to make sure that I have the right approach. When you sell puts on earnings, do you look at the at-the-money put only? No, you look at the at-the-money straddle. Sell one strike below the straddle. So if the stock price is $100 and the call and the put together add up to 10, the wings of that straddle are 90 to 110. You would go to 90 and you'd pull back just a bit and sit below the wing. Most stocks fail to beat their straddle, but don't do this on every stock. You only want to do it on the stocks that you want to own, because most don't beat their straddle, but some do. Stock at 175, at the money put 1250, sell the 160. Do you look at the money straddle and sell one strike below? There you go. Stock 175, at the money straddle, 1250. There you go. If the latter, with the understanding that you mostly sell stocks you would not mind owning, yeah, you got it. Isn't that approach sort of picking up pennies in front of a steamroller? Well, a steamroller, I think that's such a tired analogy. It's such an old, tired analogy. Let's say that a stock is at $150 and I like it, and I sell a $150 put. Am I picking up pennies in front of a steamroller? Let's say I got $3 for the put. I'm basically buying at 147. Let's say that you bought it at 150. By the time it gets to 147, you're down $3. I break even. Aren't you the one that's picking up pennies in front of a steamroller? Right? Now, if I really believed the steamroller was heading towards me, I certainly wouldn't do that. You have to have some kind of conviction. You have to have some kind of belief. I'm not just indiscriminately running around saying, sell puts, sell puts. That would be foolish. I mean, I'm looking at the underlying and I'm saying, look, I want to make sure that I don't mind owning this. So GM, I would have done that on GM. Every single earnings I would have done it, and GM's at 52-week highs. Looks like I would have been right every single time. Am I picking up pennies in front of a steamroller? Not if the steamroller is going in the other direction, right? I find that to be such a tired statement, I think uttered by people who don't truly understand what the strategy is doing. Oh, you're picking up pennies in front of a steamroller. I'm just going to go long. Yeah, what if it drops 10 bucks? I got $3 for the put. You're down 1,000. I'm down 700. Who's the one picking up pennies? Who's the one that got run over by the steamroller here? Right? So, yeah, I don't know that I like that statement. Back to my example, selling based on the at-the-money put would have yielded me 650. Not sure how much selling based on at-the-money straddle will have yielded, but it would be significantly lower. Well, the idea behind doing this is not directional. Like this is sort of a misnomer. You can have a directional play. You can be long a stock. And you know, it has earnings coming up and you're long the stock, but the options, the first expiration options, the implied volatility will spike. It will spike. So by pricing out the straddle and then just sitting below this wing, you're basically short volatility that you know the very next day is going to drop considerably. That's called volatility crush. So I'm not just making the play. If I like something, I probably have long exposure somewhere. But while it's giving me delta, if it's going to have these Vega spikes, I may as well short that Vega because I know it doesn't belong there. And if it does have a bad quarter, I'll take it. I'll take it. So if I just went around and sold puts on everything, yeah, that's a silly strategy because you don't know what you're doing. But if you're being tactical about it and you're saying, well, look, that volatility, I know it will only last until the morning. Once earnings are out, that vol is going to drop. It's called volatility crush. And I will make that money very quickly. That's a different bet. So think about it as a decision tree, right? And you're going to sell the put. And the stock price goes up. You win. The volatility will crush the very next day. You can close it. You were short vol and you win. Let's say the stock price goes down. Again, this is something you want to own. Not some random stock that you don't know anything about, or some high beta, high risk stock that could easily miss on earnings. But it's something that you have watched for a while. It has great quarters every time. It's growing its business. Its cash flow is great. GM is a good example for this, right? But every company can have a bad quarter. Every company can face a shareholder market that says, you know what? Well, let's take our profit now. That was a good quarter. Let's sell into any strength. Comes down and you own something that you would have added to anyways. You win. So heads I win, tails I win. There you go. No steamroller there. In regards to your view on Circle, do you think one should take into account the administration's recent investments in private companies as a moderate or significant risk if one were to engage in short positions? Oh, I already answered this. I think the bigger threat is Circle leaving the constraints of the Genius Act. If you're going to be short, the biggest threat you have is Circle management saying, look, with this new Fed chair coming in early in the year, as soon as he says, we're going to get these rates down, well, what they're saying is, look, we're going to take Circle's revenues and cut them in half. And its growth in its circulation is not growing fast enough to overcome what's going to happen. So that's a short, unless it leaves the Genius Act. Now it can invest its portfolio in a hedged portfolio. You can think about 70% in treasuries, and it can also step out on the curve. It can have 40% in T-bills. It could have 30% in something that has yield, and maybe the other 30% is in liquid assets that have some kind of upside potential. That's called a hedged return-seeking portfolio, like Tether has. That probably would be what would save it. Thanks for the video. I have a question about the process you go through to prepare your analysis, given the current spotlight companies. How do you start the process, especially with those companies or industries which you haven't got any prior knowledge? You find these companies and you don't just say, CRDO. Well, that's an interesting name. Let me buy some. You say, CRDO, what the hell does this company do? And you start looking at what it does. And you read and you go, I'm not following here. It's got cables. What is this connectivity issue? You start asking some questions. You search. You type in a question in Perplexity. You say, what the hell is all this? You go to AI and you say, give me a good assessment of this company. Now, you don't know if it's true or not, but it'll give you something. And then when you do a whole bunch of background stuff, you go to the 10K, you start reading, you go, okay, I get it now. I see what it's doing. You'd start the same way you'd start any other way, except the AIs are like personal assistants. Your personal assistant could be wrong. You could say, look, I'm interested in this company. Hey, Blake, because I don't know, maybe his name is Blake. Blake, give me a quick rundown of what this company does, what markets it's in, where its revenues come from. Like, what problem is it solving? And Blake will go away and come back. Except Blake will take a couple hours to do it. The AI will take 5 minutes. Blake comes back and tells you, and you got to say, well, maybe Blake didn't get it all right. Because nobody ever gets it completely right, and he's not going to understand it. He's going to read it the best he can and come back with the best knowledge he can, but there'll be holes in his knowledge, or maybe there'll even be misinformation in his knowledge because he relied on the wrong site to read it. AI is more correct, I think, than the average employee, far more correct than the average employee, faster and more detailed. And you can always then give it to another employee. You can say, thank you, Claude. Hey, Gemini, come here a minute. And you can say, look, Claude gave me this report. You know, we know what Claude's all about, right? He's not really here for the job. He's here for the paycheck. So you want to just fact check this for me? And Gemini will say, got it, sir. I'm on it. And we'll give you an answer faster than any other employee will. But there is no secret here. If I give you the name of a company, your first question will be, well, what does it do? Well, use your keyboard. Head over to Claude. Type that in. Well, what does it do? And it'll tell you. Then you look at it and go, take the output and give it to Gemini and say, is this right? And Gemini will say, well, okay, yeah, except maybe this and this and this. Yeah, okay, thanks. And as you're reading the answer to what it does, you may say, well, hang on a second. What is this technology thing? What is this? Type it in. You got a keyboard right in front of you. Type it in. I don't know. You guys are supposed to be the computer savvy generation. But when faced with questions, you seem to be looking around, looking for answers, or just walking around saying, I don't know the answer, when you have the whole world at your keyboard tip. I'm going to say your fingertips, it's keyboard. It's right there. It's your interface to the whole world. That's how it's done. You just start asking questions. Hi, Doc. What's your view on the consumer staple stock, and do you see further headwinds for them? Well, they're a defensive sector. You would need, or there's a greater demand for defensive stocks when you need to be defensive. You got a market that just keeps delivering 20 plus % a year. This will be the third year in a row. You know, and we're thinking that next year we're going to do the same thing again. It's like, well, what do I need defensive stuff for? I got to lean into this until it's all over. Then you need the defensive stuff. So when it's all over, you'll need the defensive stuff. How will you know it's all over? If you figure that out, you let me know. And everyone else on Wall Street, there's probably great jobs for you. If you can figure out when it's going to be all over, when's the right time to rotate into this? That's tough to do. If you had to guess, what do you think the monetization structure will be for the frontier models? Ad, subscription-based, or mix of both? Anything that they can think of. Highlighting product inside an answer. And giving a link to Amazon or whatever, or Walmart, where you can buy it and they get a few pennies for it, or maybe a %. Ads, most definitely, especially for the free tier and the lower price tiers. Enterprise pricing, I think, is eventually coming. It would seem to me that it's inevitable that it would eventually come. These sort of pricing distinctions, the usage limits, will start to show up. Licensing, there's a long tail of revenue that could come from this that just hasn't shown up yet or hasn't been put in place just yet. They're all eyeballing ads. All of them are looking at ads saying, why are we giving this stuff away for free? We got the eyeballs now. Why are we giving this away for free? They'll start with some ads. 2026, the year of the ads. I'm looking for ways to mimic with the lowest basis risk possible payoff of long ZQ26 without the use of derivatives. Then you can't. The ZQ is 100 minus R being the effective federal funds rate. It is not even an interest rate. It is a target rate. It's not even a real market interest rate. There is no other way to get exposure to it other than with the index. There is no other way. But not without the use of derivatives. Because it is not itself an asset. So it is only a reference rate, so it can only be accessed via a derivative. I asked this question in expert chat before, and here are some ideas. Long 2 to 3 strips or zero coupon bonds will give us a positive duration. Well, that's just duration. Getting much to capital markets without going much to capital markets. How can you not go into capital markets if you're long 2 or 3 strips? That is the capital market. But changes are not one-to-one with changes in the Fed funds. No, they're not. High basis risk, also no leverage. That's not even the same thing. ZQ is not a bet on duration at all. It's not a bet on duration. It has no duration. It is purely a bet on the effective federal funds rate, period. It is just a bet on that. Nothing more. There is no duration. Leveraged bond ETF. Nope, that's duration. Long banking stocks. Well, that's sort of the bank shot, right? If you think, well, as I say in my market outlook, my forecast for the end of 2026 is a much lower effective federal funds rate. And if you have a lower effective federal funds rate, the 3-month will hug very closely to that. So banks funding their overnight cost and their short-term funding will be very low. And if you believe that it will create a steeper curve, which I think it will create a steeper curve because the long end is not going to be 1 for 1. The 2 to the 10 will steepen, but more importantly, the 3-month, the 10-year will steepen. Lower funding rate, lower liability cost. Higher curve from the 3-month to the 10-year means they can borrow cheaper, lend richer. You have a greater net interest income margin. Now, whether or not the interest income will be higher will depend on the 10-year. You can get a curve steepener with the short rate falling 200 basis points and the 10-year falling 100 basis points. You'd have a 150 basis point curve at that point. 120, I think, because the 3-month to 10-year is only about 20 right now. And you'd still have a lower 10-year, which would mean higher loan volume. So your net interest income and your net interest margin would both be higher. Those are the two big hits for banks. So yeah, that is sort of a bank shot that you can play. 2 to 3 logical steps away from lower Fed funds, too high basis. See, if let's say that you get a cut in the federal funds rate because the credit markets have seized up. And you had a big bank failure, ZQ will win and you'll lose on your bank stock. So it's not the same play. It is a play on ZQ dropping for the right reasons and everything going right for the banks. Long gold will benefit from lower yields, but inflation uncertainty and no leverage. Not if you're not using derivatives. Nope. If you cannot use derivatives, just you're not in the game. but every game needs fans. So I'd say take a seat in the bleachers and cheer us on. Anyways, that is the end of the questions this week.